Welcome back to the channel. If you're buying and selling crypto in Australia, this one's important because how you're taxed depends on whether the ATO sees you as a trader or an investor. So what's the difference? Well, it's not just a label. It could change your tax bill by thousands of dollars. In this video, we'll break down the key differences between crypto trading and investing, how the ATO classifies your activity, what kind of taxes apply, and how to stay compliant. Let's get started. Most casual crypto users in Australia are treated as investors. That means you're holding crypto as an asset, similar to shares or property. You're hoping the value increases over time. The ATO sees you as an investor if you buy and hold coins for long-term growth, you're not trading daily, and you're not relying on crypto profits as your main income. Maybe you're checking prices occasionally, but it's not your full-time focus. In short, you're treating crypto as a long-term investment, not a business. As an investor, any profit from selling crypto is treated as a capital gain. And if you've held the asset for more than 12 months, you get a 50% capital gains tax discount. Only half the gain gets added to your taxable income. For example, if you bought Ethereum for $4,000 and sold it 18 months later for $10,000, that's a $6,000 gain. Because you held it for more than a year, only $3,000 is added to your income. If your tax rate is 30%, you'll pay about $900 in tax. Now let's look at the other side. What if you're trading crypto actively? If you're buying and selling crypto frequently, maybe even daily. If you're using trading bots or margin platforms. If you're pouring in significant time and capital. And if you're tracking markets to make short-term gains, then the ATO might consider you a trader. And that changes everything. As a trader, your profits are not taxed as capital gains. They're treated as business income. You don't get the 50% CGT discount even if you hold coins for more than a year. But you can claim deductions for your trading expenses. You can also offset losses against other income, including salary. Here's a quick comparison. Let's say you made $40,000 from crypto activity this year. As a trader, that entire $40,000 is added to your taxable income. If you have a full-time job earning $60,000, your total taxable income becomes $100,000. You'll pay income tax on that total. As an investor, if that $40,000 profit came from selling long-term holdings, only $20,000 would be taxable after the discount. That could be a huge difference in the final tax bill. So, who pays more tax? Usually, traders pay more because they don't get the 50% CGT discount. Every dollar of profit is taxed like normal income. Let's say you're in the 30% tax bracket. As an investor with a $20,000 capital gain, you'd only be taxed on $10,000. That's about $3,000 in tax. As a trader with the same $20,000 gain, you'd pay $6,000 in tax. But traders can claim deductions that investors can't. Trading subscriptions, platform fees, internet costs, even depreciation on your computer. If it's used for trading, it could be deductible. Also, if you've made losses, a trader can offset those against other income. So which one is better really depends individual situation and your intention to trade. If you're mostly profitable and holding long-term, investor status is generally more tax-friendly. If you're trading frequently, trader status might work better. Can you choose whether you're a trader or investor? Not exactly. The ATO decides based on your actual behavior. You can't just declare I'm a trader because it suits you that year. They'll look at how often you trade, how much time you spend, whether you're trying to generate a profit regularly, and how significant your crypto activity is. It's also not flexible within the same year. You can't be an investor for one coin and a trader for another. But you can change status in a new financial year if your activity level changes. Now let's talk about records. Regardless of your status, the ATO wants detailed records. You'll need to record the date of every crypto transaction, what type of transaction it was, buy, sell, swap, earn, or stake, the amount in Australian dollars, any fees you paid, and why you did it, whether it was for investment or business. Crypto tax software can help. Tools like Coinly, Coin Tracking, and Crypto Tax Calculator can sync with exchanges and produce ATO-friendly reports. This makes it much easier at tax time. And remember, the ATO has data matching agreements with major exchanges. They already know more than you think. Now let's cover some common extras: staking, airdrops, and DeFi. If you earn crypto through staking, it's treated as income at the time you receive it. So if you receive $1,000 worth of tokens from staking, that amount gets added to your income. If you later sell those tokens, you'll pay capital gains tax again on any increase in value. So yes, staking can trigger both income tax and capital gains tax. Same goes for airdrops. If the airdrop is expected or comes from a project you interact with, it's considered income at market value. Later, when you sell those tokens, capital gains apply. Even if you're normally treated as an investor, earning from staking or airdrops can create income tax obligations. Let's summarize everything. If you're holding crypto long-term and selling occasionally, you're probably an investor. You'll pay capital gains tax and may be eligible for the 50% discount. If you're trading actively, you're more likely a trader. You'll pay income tax on all profits, but can also claim business deductions and offset losses. You can't just choose. The ATO will assess your behavior. But you can plan ahead and adjust your activity to suit your goals and risk profile. The key is to know where you stand, keep great records, and report everything accurately. If this helped you understand how crypto taxes work in Australia, give the video a like. Subscribe for more tax and investment tips tailored for Aussies. Thanks for watching. See you in the next one.